April of 2022, rates started to go up. The 5-year fix was at 4.09%. So average property in this area, for it was a condo, they were hovering at 800,000. So back then, with 200,000 down payment, the payment would have been 2,883. October of 2023, that rate is sitting at around 6.14, let's just call it.
Yep.
And the value of the same properties right now is at 650,000.
Oh, wow.
150,000 drop.
So you have a higher rate, lower price, and the
And
average.
200,000 down payment that you're still paying,
Yep.
your payment is 2716. So yes, the rate has gone up, but if you're buying right now, like your payment is even lower. Hi everyone, and welcome to another episode of NK Real Talk. Today we got Piero, mortgage specialist with Bank of Montreal, to see what's happening in the mortgage environment. Piero, thanks for coming.
Thanks for having me.
So tell us what's happening right now with mortgages, because
Yeah, I mean, it's an interesting time for sure. You know, the rates are staying high for a little while, I think. I think we're going to see things start to drop in the new year. Is the anticipation. Again,
Right.
no guarantee. We'll see what happens. I know the Bank of Canada is going to meet, and we're going to see what happens with the variable rates, and then that'll kind of determine what happens with the fixed rates, the bond yields, and things like that. So.
When you say drop in the new year, do you mean like in the first, second quarter, you think?
Some economists are anticipating, like this time next year, the second half, the third,
Right.
fourth quarter, we're going to see some softening in the bond yields, and we might see the rates start to follow. So I think it's
Cool.
going to be a little bit of short-term pain, but long-term, you know, we always come back down.
Okay.
So that's the usual trend.
so it's worth mentioning that at the time of recording, this is prior to the October 25th rate announcement.
Yes.
We have the final rate announcement of the year is December, right?
6th, yeah.
December 6th. So there's not much.
Yeah.
It's interesting, yeah.
Yeah.
So we got October, and then we got November, nothing, and then we got December.
Yeah.
And depending on, what happens with that, I think we will know, I guess, what's going to happen in real estate. Do you think, in terms of rate hikes,
Yeah.
like the probability of,
I think we'll still see some surges in the fixed rates. Again, we wait and see what happens next week with the variable rates. But I think we're seeing the bond yields start to go up, and we're going to see the fixed rates start to go up. Again, like I said, maybe a little more short-term pain for a little long-term gain. So we'll see. What happens.
So for those who are watching, let's just break it down why the bond rate is
Beautiful.
important.
Yes,
Okay.
that's what I wanted to say. We need to spend some time on
yeah,
that.
exactly. So why is bond rate important for fixed term mortgages?
So everyone speaks, when they talk about the rates are going up, they usually are talking about the variable rates.
Okay.
So when the Bank of Canada meets, we see these rates go up, quarter point, half point, that we've seen over the past year and a half, call it. When people hear this, they think, oh, that's when the fixed rates are moving up. And again, it's totally different. It's based off the bond market. So think of the bond market as savings, right? So they want to slow down the market, so they're going to give you more interest on a savings account, so you're not going to spend as much money. So that's when we see the bond yields start to go up. And as we see the bond yields start to go up, the mortgage rates go up.
So that's the driver.
In terms
Call it. That's the reference point that everyone uses, like the marker.
For the bond, yeah, the bond
Right?
yields will dictate what the fixed rates do, right? So
Cool.
you look at, and we looked at earlier, look at bond curves. Yesterday it shot up, today it's dropped quite a bit, which is a good thing to see. But that's what's driving the fixed rates. And again, people say, oh, next week rates are going up. Well, the fixed rates could have gone up and down 3 or 4 times between announcements. And again, people don't realize that it's totally different comparison.
Right.
If that makes sense.
So bond yield affects the fixed. What affects
Yeah.
the variable?
The overnight Bank of Canada rate. So that's what you hear.
So
when you hear
can you just walk the people through the differences of that?
Yeah, so the government dictates what the overnight the Canada rate's going to be. So when we see that change, you're going to see the variable rates change. Your line of credit, your credit cards, anything that's based off of prime is going to change.
What is prime right now?
7.2.
Okay.
Yeah. So if
High.
we see another quarter point, So if we see another quarter point, that's going to go up.
That's an interesting one, yeah.
Yeah.
Stress test.
Stress test.
So what is the stress test sitting at right now?
So depending on what your rate is, right? So what I wanted to do is kind of rewind back. So
Cool.
in the heat of the market, when everything was dirt cheap, the stress test was, the Bank of Canada rate, which back then I think it topped out at 4.29. Sorry, 5.29.
When was this? Sorry.
Say, during the pandemic, 2020, before the rates have gone up. So the indicator is 2% above your actual rate or the Bank of Canada rate. So right now we're sitting at 2% above your rate because it's above the Bank of Canada rate. So, in the heat of the market when everything's going crazy, people are qualifying at 5.25, call it 5.3. Now, if the 5-year fix is at 6.5, now you're qualifying at 8.5, which has affected how much you can afford. So
I'm so for this stress test, and I think that it was kind of the blanket that everyone really needed in this time, and no one's seeing the value in it.
Perhaps, hindsight is 2020. Back when we introduced it, people were like, well, why am I being approved at 5.25? My rate's at 2%. Why, that I could afford more? Well, now you fast forward a few years.
Could you imagine what would have happened, guys, if that wasn't implemented and that was not in place?
Yeah. So we'll see what happens. Like I said, rates are well above that Bank of Canada rate. So even, I take a lot of things with a grain of salt. So, we'll likely see rates start to come down. So the mortgages that were taken on in 2020 come due 2025, obviously, 5-year rates. I think we'll likely come and settle down into where that stress test rate was back then. Right? Everyone's, freaking out. It's like, oh, I'm at 2%. If my mortgage renews at, even 5.5%, I can't afford it. Well, no, you can, because we approved you at that rate. So a lot of people are panicking, and again, maybe a little too early to panic, because again, if we see these rates start to come down in the short term, again, a year from now, sort of thing, we might still be a soft landing, but time will tell in terms of where we stop with these rates and when they start coming down.
Well, definitely, once these mortgages come for renewal, a lot of, in my opinion, we'll see a bunch of sales happening based on the mortgages that people got.
Yeah, I mean, they feed off each other, right? The rates go up, the housing market slows down a bit. If rates are coming down, there's a lot of more consumer confidence. A lot of people want to, buy and sell. So again, we'll start seeing that stuff come up again.
I'm talking more about the fact that a lot of people that locked in low rates, and now the time for renewal comes. I mean, if they're not comfortable with the new rate and the monthly payments, they're probably going to sell the property, opting for another option if they're not comfortable with
If they're not comfortable with it, yeah. And again, it's knowledge, right? So when I sit down with people and you're pre-approving them, you say, okay, this is the mortgage process, and especially first-time home buyers. Say, okay, this is your actual rate, but this is what we're approving you based on. So the stress test, all the things that we use to GDSRTs, all the ratios that we look at, right? So I go, based on the stress test, this is what the payment that we're using that you can qualify at.
So it's a monthly payment that you guys really try to figure out.
Yeah, monthly, bi-weekly, however you want to break it down for. I say monthly. I usually start with monthly because I always tell my clients to make a budget. Say, okay, you know what, you guys.
Budget, that's a word I can't stand.
Budget? Yes.
Okay.
Yeah. But when you're being approved for a mortgage, we're looking at your gross income.
Yeah.
Right? You live on net. Right? So, if it's a salaried people, you say, okay, you know what you're taking home every 2 weeks. Now figure out your monthly income net. Take away your mortgage, take away your taxes, take away your utilities, take away your car loans, all these things like that, and you'll know exactly what you're left with, right? So again, the stress test back then when we were at 5.29 or 5.3, again, I still explained it to them saying, based on this rate, you can afford it. And obviously it's great because you got a lower rate and you're going to be more affordable for you. But again, in the eyes of the government, the Bank of Canada, you can still afford it at that rate. So, but to your point, yeah, we may see people, downsizing, selling off, things like that, right?
Yeah.
So
probably what, 2025, 2026?
Well,
we're seeing it a little bit now, people that can't hold on, the variable people.
Yeah.
And I feel like the people that obviously did get mortgages in 2021, 2022, they're coming due, what, 2025, call it 5 years?
Yeah.
Right?
Yeah. And keep in mind, 2019, pre-pandemic, rates were, call it a 5-year fix, was in that I think it was around 3.3 to 3.5% range, somewhere around there. And it was anticipated into 2020 rates were going to continue to climb. So we're heading towards that 4% range and potentially higher depending on what happened in the market. And then the pandemic hit.
What a left
right?
turn
So
we took.
2019, those mortgages are coming due next year. So if you're at, call it 3.5, and if next year we see things start to come down a bit into that, into that 6 range or high 5s, it might be okay. It might be a nice soft landing there, and we might not see too much of a problem. But again, like I said, I think we're going to see the anticipation is rates are going to keep on climbing a little bit and then kind of level off and come back down.
While we're talking about the fixed rates, so you mentioned the bond rates will determine the fixed rates.
Yep.
How long will it take for it to
Come back
affect
down.
affect the fixed rate? So, for example, we had the banking crisis earlier in the year.
Yeah.
We saw the bond rates fall down into the threes.
Yeah.
But we didn't see the fixed rate mortgages drop down as quickly.
Yeah, I mean, there's a cost of funds, right? So the banks have their what it costs to lend out the money. You know,
We've had this chat before, I remember.
Yeah,
I
so-
called you, you were my first call. I was like, what's going on? Explain this to me.
Yeah, so I mean, there is a fixed cost. So I mean, you could, depending on what the spreads are and what the costs are, it's actually fairly. I don't want to say it's not real time, but it'll map out. Rates go up. Eventually, if you see enough of an incline over, say a month or something, you will see those fixed rates start to move up, right? On the downside, again, depending on how long
It'll probably
it takes,
take longer.
right? Because the bank doesn't want to, drop and then all of a sudden
that was
take
my
off
point.
and then we got to start.
Right.
So
It
that
takes a longer time.
well, I mean, there's a lot of consumer confidence issues that way, right? If you start dropping and it starts going up again, people are going to be like, "What's going on?"
Because we had a good drop for a good 3 weeks, I think,
Yeah.
when the banking crisis happened. But fixed term mortgages, they were all the same. And we saw the fixed rates come down around April and May.
Yeah, exactly, right. But again, you probably want to see a good 3-4 weeks of steady decline before they start making those rate changes, right? And again, there were some weeks where we saw 3 hikes in a week.
Right.
And again, they'd be marginal, a few basis points here and there.
So
but
essentially what I'm saying is so they would raise it quicker than they would drop it.
I wouldn't say that. I think,
No?
you probably see a good 3-4 weeks of steady
Really?
incline before you see the rates start to go up.
Good. Okay.
Yeah.
So that was a question I had.
And again, that's dictated by the banks and the lenders and stuff like that.
They
But again,
decide.
they decide
Yeah.
in terms of, when are we getting to a point where the cost of funds is getting close to where not being profitable.
Right.
At the end of the day, it's about profits, right? Too.
So what kind of incentives is BMO specifically having for you or?
I mean, a lot of the banks, BMO has it included. We have, cash back offers
Okay.
that you can do towards legal fees, things like that. So we're having a lot of that stuff. I think a lot of banks now, a lot of lenders are, to your point, focusing on the refinance clients, the renewals that are coming up and things like that, right? And
Because at the end of the day, the bank is not in a real estate business. They don't want to take your home.
I say that
right?
all the time. I have clients
Right.
that say, well, if I don't qualify, you can take my home. Well, we
Like,
don't
I don't
take
want your
home.
house. Yeah, I'm not a
I mean,
property
it's
manager.
Bad press. It's not what we want to do. We lend money out. We want to be paid. That's how all the institutions work. But in terms of renewals coming up, and there's a lot coming up in the next couple of years. I think a lot more rate shopping will be happening now. Because keep in mind, your mortgage comes due now. The bank offers you a rate. Okay, take this rate. You can take it now, and you can do that at 6 months early. Well, now people don't know what's going to happen in 6 months, right? You go to the banks, or any banks. Bank of Montreal has the longest rate guarantee. We do 130 days, which is great. So a lot of people
You do 130?
yeah. So call it 4 months or just over 4 months. Say okay, lock in a rate now for 4 months. The benefit is you have what it's going to be worst case if it goes up.
Right.
If it drops, you get the benefit of the drop.
Right.
And you're not a lot of times it's you're coming off say a 3% rate. It's like I'm going to 6%.
Double, yeah.
6 months early.
Yeah.
I'm like, okay, rate hold it with
what
What's the
whoever,
worst,
and,
yeah.
and then which worst case is going to be, and then if it's better come renewal time, you have a lower rate.
Well, one issue that I see with a lot of switches right now is people are not able to switch the bank because when they got qualified, they were qualified at a lower rate, so they had an easier time getting that mortgage.
Yeah.
Now they got to go switch to another bank, even if it's got a better rate, they may not even get qualified.
A lot of things change though. It's the rate, yes. Have they taken on more debt? Have they taken on, have they bought
Look, just
cars? Have they?
They're over
Assuming if
leveraged,
it's
yeah.
all the same,
Yeah.
they're gonna have a tougher time getting approved, of course. If they
Yeah.
switch, but if they're remaining with the same bank, there's no more.
There's no more requalifying.
yeah,
And
requalifying.
again, there was talk about renewal time requalifying and things like that, and that thank God hasn't happened because I
Right.
think that might be a real issue too.
Well, I mean,
but
like-
again, it doesn't hurt to try, right? To say, hey, you know what?
sure.
Okay, my mortgage is coming up in 4 months. Let's see what the rates are.
So
lock
let's
it in.
explore that. So if the banks say, okay, when the renewal comes, you gotta requalify. A lot of people will not requalify. What? You gotta go sell your house now?
Again,
That
I
would be-
don't
that
know
would-
that's
He was
gonna
laughing.
happen.
I'm like, I'm just looking at these scenarios in my head. Like that would be a
He laughs when he's
disaster.
panicked. He laughs when he's panicked.
It's not happening. It's. I mean, there was grumblings about this.
Right.
It never happened, thank God. But
Well,
yeah,
listen, like,
that's
there
a
was a-
that's a real possibility.
There was a
right? That could
rumbling
happen.
about like adding luxury tax to the homes.
Yeah.
It
Here we
happened.
are.
Here we are. So,
Yeah.
so,
Cheers, yeah.
Yeah.
but okay. So, any other rumors they might be doing? I gotta
Let's
take.
put these to rest.
I gotta-
or-
Well, again, we don't know, right? So you mean, I'm a advocate of, okay, we have 30-year amortizations. Do we introduce the 35 again?
Right.
We were up to 40 at one
Well,
point,
that
right?
is what I was gonna say.
So do we reintroduce that 35
So it's
year?
back to 30.
We always had 30. It was up. We were at 25 maximum. Then we went
Right.
to 30. Went to 35. And went to 40.
Because I was gonna say they extended it.
They extended it. Now we're back to maximum
back.
30, right?
Okay.
So maybe they look at that.
And this is
And
40.
again, that's going to depend on a lot of things in the market, right? If these rates stay higher for a longer time, then maybe they have to give something to.
Do you think that if that were to happen, that they would implement this so-called boomer that you were discussing? They would come up with obviously a program for you to be able to keep your home.
No one knows.
In hindsight.
Maybe I
Maybe,
don't know.
maybe
Again,
not.
we're
Okay.
talking. We're guessing.
No, that's it,
It's
this is it,
it's a crystal ball question. I don't know.
Okay.
Right. So don't.
Yeah, let's
I'm
let's
so
not let's not
confident.
let's not dig into
don't
that
rock,
right
don't
now.
rock the boat. You don't know, right?
Being Canadian, I'm like, the government's not gonna, they're gonna figure out ways and programs for people to.
Yeah, private lending. That's what it's called.
But yeah. But like you guys
Switch
said,
gears.
the banks, the institutions are not in the business of
Yeah.
kicking people out and,
Yeah.
and selling their property. They'll work with you to try to get or figure something out, right? So
That's interesting. Okay. So while we're
What are you
With-
gonna talk about?
we discussed the whole fixed rates
Yep.
and variable right now. In terms of what, let's say, like we all know, like right now, I think it's been the worst that I've seen it since
Ever.
probably like I don't know 2000 like what like 7 8.
Yeah.
What was it like 2006 was the highest rate we had or 2005? It was
Historic
around,
rates. I'm trying to think of when. No, I mean, I bought my first place in 2007, and I was in the 5% range.
so in
That's
or around
not
that
bad.
point.
No, hey,
Do you consider this yes, it's a high interest rate environment if we consider the last couple of years. Agreed. But do you feel like it's not a healthy number, more or less? We're on the higher end of the healthy number, but
again, we say, okay, I was at, just call it 5.25,
Mm-hmm.
my first rate on my first mortgage. Yeah, but I didn't pay $800,000-$900,000 for my property.
yeah.
That is a very solid
highlight,
point.
yeah.
So
Right? So again, the discrepancy between how much of the rate's gone up versus how much
Price.
the prices have gone up, it's huge, right?
Yeah.
And one of the stats that I've always remembered since I think the 50s, houses have doubled in price every 10 years. And that has jumped far beyond in the past.
So
That's the scary
historically,
part.
it's been 20 years, and it jumped down to 10. But realistically, I would say in the last 10 years, every 5 to 7 years, in majority of the GTA areas, it doubled up.
Doubled. So
Yeah.
again, that's compressed to a small
And
time.
I would say, like, I've seen properties that were bought, around, let's say, 2018, that were sold at the peak 2022, and they were doubled.
doubled.
Yeah.
They're so
And we're
busy in their
talking about, like,
conversation, but can you repeat what you just said? That housing doubled? Just because we need like a shameless plug for this.
But
Appreciation.
again, but you said it's even
Yeah.
further. So since I think the 50s, every 10 years was the study that
Yeah.
houses doubled every 10 years.
10 years, yeah.
And
Case in
call the
point.
past 10 years is
Yeah.
probably even less than probably every
Yeah.
3 or 4 years.
Yeah, depending on when you
Why
buy
I
it, like,
say this
if you
is
want to get at
obviously because
Well, listen,
you get the equity back at a,
hey, I mean, when I bought my house, and I'm, it's years ago, and I'm
Years
on-
ago.
years ago, 2007, and which is, I paid $230 for my townhouse.
the townhouse you're at now?
Yeah.
Huh?
So when I bought my townhouse, and I knew that the stats, I'm like, there's no way my house is going to be worth $500,000 in 10 years.
Right.
Back then,
Mm-hmm.
it topped out in the pandemic. It was almost $1 million, right?
Crazy, yeah.
So, and that's
And
not
that's
even
out in Hamilton.
yeah, that's not even 10. Not even 20 years, right? It more than doubled.
I know properties that someone bought in 2007, 2006 actually, because I specifically remember it. They bought it for $630,000. They sold that in 2017, peak of the market.
Yeah.
So $630,000, they sold that for $3.5 million.
Oh,
Wow.
what a Pretty day for them.
So yeah, I mean, we're going to see, you know, and you guys probably talk this more than I could, you know, they're flattening out. The increase in values are kind of flattening out.
I think it's because of the interest rates.
Because of the interest rates,
people
yeah.
are so in like this panic right now and
Yeah.
not entertaining that.
No, I think it's more the
Consumer
insecurity, the
confidence.
consumer
Yeah.
confidence. You know, I think once we get to that point, we say, okay, now we reached the top. It's going to be flat for a while, and even if it stays high, but we know it's going to be flat, people are going to know what their budget is. They're going to know what the prices are. And the fear is, I'm going to buy a house for $1 million today. If things continue, is it going to be worth $800,000?
Yeah.
When will we know if we reach the top? You just said when will we know? Like what?
It's hard to
More
say.
or less.
Listen, you know, there's so many. There's more things going on today globally than there was even in 2008 when we had the first, you know, big hit, right?
Yeah.
You know, global wars, all these things that are affecting everyone globally more than they ever were, right? So again, you know, when we're going to see the plateau, I mean, I think when we see, you know, a good, yeah, I'd say a few months of, you know, no really increases, bond yields holding steady, the Bank of Canada not, you know, doing any increases, I think that's going to really give some consumer. And I think we've seen it. I think earlier in the year when the bank didn't do any rate hikes,
April?
we saw a bit of a uptick in movement in the properties and things
Big
like
time.
that. So again, we had a few months of nil movement, and I think people, and I think some rates come down at that point too on the fixed side, and people were, you know, we saw a little uptick in movement, right?
So again, like to add to the whole point of whether or not, like, you know, right now it's affordable, a good time to buy. We've been working on a chart, and like we're gonna do an episode on the whole fact that would it be better right now to buy, because there are so many opportunities. Like we always talk about assignments, but even like on detached. So I have a little chart that we're gonna put up that April of 2022, rates have started to go up. The 5-year fix was at 4.09%. So average property in this area it was a condo. They were hovering at 800,000. So back then, with 200,000 down payment, the payment would have been 2,883. October of 2023, that rate is sitting at around 6.14. Let's just call it.
Yep.
And the value of the same properties right now is at 650,000.
Oh wow.
150,000 drop.
So you have a higher rate, lower price, and the
And
average.
200,000 down payment that you're still paying,
Yeah.
your payment is 2716. So yes, the rate has gone up, but if you're buying right now, like your payment is even lower.
Yeah.
So, but again, you know,
It's funny, and someone said this to me. I can't remember who it was. He said, "Marry the property, date the rate."
that's what it is.
Oh
yeah.
wow.
Right.
See, it's
you're-
always back to dating. I told you.
Yeah. So long term is that price, right? If you can save 10%.
You cannot
price,
renegotiate the price once you buy it, but you
You're-
can always renegotiate your rate.
anytime, right? So, and I tell clients that, you know, you say, okay, the rates are really high. I'm like, okay, you know, people are doing shorter term, but
Right.
there's nothing stopping you from breaking your mortgage. Yeah, there might be fees and penalties, but again, your mortgage professional is going to break it down for you. Say, okay, yeah, your penalty is X, your new rate's this, your payments are this, your interest savings are you know, whatever over
X,
this
Y,
term.
Z,
Does it
yeah.
make sense? I mean, the good thing with what I do, it's pure numbers.
Yeah.
You know, interest rates, calculation, payments, interest savings. It's not you know, it's not something that you could hide behind with smoke and mirrors. It's real numbers.
Like today's value, hands down, any segment of the market, you're looking at condos, detached townhomes, anywhere you go, right now, as of October 2023, even if you go back 6 months before, the values are much lower. There's no doubt
Yeah,
about
case
it.
in point.
But again, back to the consumer confidence. Now they think, okay, do I buy that now, or do I wait and see if it's going to bottom out a little more?
Most of my clients are awake still right now.
Right.
And that's the thing.
But let's
When
just put that in
2, 3
perspective.
people go, then 4, 5, 6 follow, and then pent up demand.
There's a lot of people on the fence
Click.
that don't know what to do yet.
But I want to put this thing as an example. So let's just say if someone was to buy, peak of the market this year, let's just call it being May.
Yeah.
If someone was, like, had purchased something in May,
Yeah.
and right now they want to purchase it, which is lower, what's the difference? Because we have clients all
In
over the place.
affordability, it's not much of a difference. You're right.
Because I've taken percentage of a lot of areas, and we're talking anywhere from 4%. I've never seen anything more than 7%.
Yeah.
Right. So we're talking about maybe, you know, you've dropped down in that level, but are you able to find what you were looking for right now? Because a lot of people are buying something to live in for 10 years. You may not have it right now on the market. So if you've seen it, you got to buy it. If you see something right now, why wait? How much more is it going to drop down? Is it going to drop like what it did, 30%? Unless we're having a massive disaster, I don't see prices going down 30%. Will it go down 1, 2, 3%? It always does. Every month it goes up and down. Like you got to look at it at the big scheme of things, and it will all the trend is always up. That's what we say. Like the 10-year average is 7%.
Yeah. Again, you got even the clientele, you got to break that down too. First-time home buyers having a very difficult time. But
processing, it's a lot of information.
Well, not only that, in terms of being able to get into the market, right? Because the rates are higher, so they're affording less, and they don't have that down payment. Whereas people that have been in the market, so they're resale and buying. Well, they have a mortgage rate likely that they can maybe port or do whatever and blend the rates. They have some built-up equity in their house because if they bought, they have that $200,000. Yeah. Right, and they're getting a steal because the new house is cheaper.
Yeah, the upgraders are really winning right now.
They're winning right now, for sure.
Yeah, cashing out, no. I have a question for you. I just forgot.
So while we're there, the opportunity is that
Wait, I forgot. I actually
like the fact that you said that because that's where the opportunity is. Like if you're upgrading right now, that's where the opportunity is. Like majority of these more expensive, let's call it like the luxury homes, the drop has been more massive compared to towns and semis or smaller type of homes. We're looking at, let's say, areas, for example, let's just take Baby and York Mills as an example, because over there's massive swings.
That
properties
so bad.
properties that are like sitting on the market at around $6-7 million are sitting on the market, whereas something comes on the market around $3 million even, which is still high, still goes like $2.5 million.
Yeah.
Like it will still sell. Whereas I'm seeing properties at like $7 million been on the market for a year right now. Like nothing's happened.
But again, I always say, think of it as a pyramid, right? So when you're in
I love these analogies that you have. You should box them and send them to me so I can use them.
So the higher you go in price, there's less clientele in that market, right? So you get, and again, depends on pockets, right? And again, I don't know what the sweet spot is in this area, and it could be that 800, 700,000 condos or whatever, that might be that sweet spot that you put it on the market, it's going to sell. Right, and those are the ones that are those are the ones that are going to be driving the market for a little while. I think too, right?
I just remembered. I just remembered. I don't want to cut you off, but I had to now because otherwise I would never remember. Are you seeing? Because I really want to know this. Are you seeing a lot of, especially the first-time home buyers, obviously, are they doing the insured mortgage like less than the traditional 20%? Are you seeing that now more than ever to help with the gap?
Again, it doesn't go away, but again, the rules around insured mortgages are tighter. Are tighter. So if you have 20% down, your qualifying payment is based on a 30-year. Okay. Amortization. Okay. If you're less than 20% down, your qualifying rate is still this trust test rate, but now it's only 25 years. So your payment's calculated over 25 years versus 30 years. So your payment is going to be higher on that you're qualifying at, so it's going to affect what you can afford. It's going to bring that down. The debt servicing ratio, so TDSR, GDSR, it's black and white. It's 44/39, right? So if you're at 44.001, they won't approve it. Bring it down. So a little more down, have a little more, whatever the case may be. It has to be right in line. They're pretty much black and white. When you have 20% down, is there a little more gray area? Can you go to 44, 45, 46? Depending on the strength of the client, yeah, there's a little more wiggle room.
But are you doing, like your business, are you doing equally the amounts, or you're doing more traditional, the conservative 20%?
Again, the first-time home buyers, they're going to likely
They are shifting a little more?
Again, unless there's, gifted equity, parents are helping out, things like that. And we're seeing that a lot. We are seeing that a lot. A lot, right? So but again, I'm still seeing some high ratio mortgages for sure. But again, a lot of people that are coming in with that, and they're seeing, okay, what they're getting approved for isn't what it was even a year ago. Sometimes they're sitting on the fence now and waiting. So
makes sense.
Yeah.
Okay, so in terms of refinances and switches, if someone is thinking of refinancing, which is going to lead us to our next section, but like refinance and switches, what should someone do to prepare to do the refinance or switch?
Like say you have a 6 month out, and then for an example, like if you know that you're having a renewal in a year.
So most of the lenders, they'll let you renew 6 months early.
Okay.
And you know what it's like, you sign a piece of paper, you know, go, this is the rate right now, sign right now.
That's with the
But
same
they're
bank.
not holding that rate for 6 months. It's like, okay, this is your rate, you got to
Right
sign,
now.
say 5 days.
You're renewing as of today.
As of today. So a lot of clients that are coming in that I'm talking with is like, well, they're giving me this rate. I'm like, yeah, you know, I'm the same rate. Like, but I got to do that now, and I'm leaving a call it 3% rate or whatever to jump into a 6% rate 6 months early. So I'm, you know, their payments are going up, their costs are going up, all things like that, and they don't want to lose that rate. So a lot of times I'm saying, okay, let me hold my rate for 130 days. So, you know, lock that rate in 130 days in. Now you know worst case what the rate's going to look like.
So
You've
it's
been
the plan B
approved.
to the plan A. Got
Yeah,
it.
right. And you say, okay, and get that locked in for long as you can. Ours is 130 days. You get that locked in, so 130 days prior to your renewal, get that locked in, and see what happens with the market, right? So a lot that can happen in 130 days. We might see those rates start, and if you can save 10, 15, 20, 30 basis points on your renewal rate, that's money in your pocket, right? So again, talk to your provider, you know, see what they can offer, and if
Call
you get
Piero.
stung, call me. But again, nothing wrong with shopping around. Back to your point, yeah, it might be a little harder to approve, but again, you don't know unless you try.
Well, like in terms of like preparation, like should they just make sure like they hold off on the purchase, they hold off on checking their credit, they hold off on like doing something that messes with their credit?
Well, again, adding more debt is going to be a huge factor, especially with the rates being higher, right? So what you can afford now versus what you can afford before is already higher because of the stress test. If you're taking on more debt, things like that, you know, that's a problem. And again, a lot of people will come in, they're gonna, you know, renew, and at the point you say, okay, you know what, hey, you have some credit card debt at 18%, you have this, you have that, you know, loans that could be higher, things like that. So, you know, can we do something to consolidate to make it a better overall picture and help you cash flow wise too? Yeah. That might be.
So the takeaway is essentially pay down any debt.
Not always.
No?
Again, keep in mind, you know, some people like, so, you know, I had clients come in, an older couple, they were retired. And, you know, they had their mortgage, I can't remember where it was, they came to me and they said, okay, you know, I do the application.
They were shopping.
They were shopping around,
Okay.
right? They're like, you know, we have some debt that we might want to consolidate. We have this. So I looked at their application, they had some credit card debt, all these things that were there, and had a car loan, they had all these things. And, you know, I go, send me everything, you know, I roughly know what the rates are on the credit card, but send me your car loan information, right? And a lot of people don't know this. Sometimes the car loans are, you're paying for your loan includes all the interest, right? So it's front loaded. So you say your loan was $20,000, and with the interest it's $23,000. So your loan's $23,000. You can't back out of that. I think you have like maybe 6 months sometimes to grace period to say, okay, I've paid it off in 6 months. I don't want to pay that full interest. But a lot of times, if you're into it, well, you've already paid that interest. It's already included in the loan, right? At that, you know, 9, 10%, whatever it is. So back to these clients, you know, I looked at everything and say, hey, listen, you know, sometimes it's not just interest. Sometimes it's okay, pay off the credit card, pay off the car loan. I freed up, I think, like $1,500 a month for them, and they were, you know, pensioners, so they're they had their fixed income.
Mattered.
You know, the lady was crying. She was like, "You saved me $1,500 a month in payments." They were happy. So again, it's every scenario is different. Yeah. Right. Sure. So it's one of those things where, you know, is there debt that we can consolidate instead of just doing a switch? Well, I mean, there's more fees involved and things like that, but it might be beneficial to clean some stuff out. And again, over the past couple of years, a lot of people have taken on more debt, right? People have, you know, renovated their houses that we were talking about earlier. You know, they throw more money into the house and they borrow for that, you know, lines of credit, loans, things like that. They might say, okay, you know what? Let's not think about interest, think about cash flow. Because a lot of times, those could be two different conversations, right?
Right.
So maybe one of the last points that I want to talk about right now, given the current situation, is if someone is refinancing, how can they use that refinance money to purchase another property?
Yes.
So what's the logistic of it? Because sometimes, you know, I get the question, okay, you know what, I'm going to refinance. Well, I'm going to have a higher payment here, then I'm going to buy something. I'm even going to get qualified. Yeah. Like, how does the math on that works if they're buying into it? If they have an existing investment property and they're buying another one.
So not even their residence and existing rental property?
Two situations. So if they have a personal residence, they want to pull the money, buy an investment property. Scenario one. Scenario two, they have another investment property, they want to pull the money out.
Done it many times, yeah. And again, it comes down to situations, right? So it's debt servicing, things like that. So, you know, first-time buyers, you know, they have their house and then they want to buy a secondary. But some have savings, this and that, they can do it, and they have savings for that 20% down. And again, you're buying a rental property, your minimum down payment is 20%. You can tap into the equity, and you have a couple ways of doing it. Generally, the better way is, have a secure line of credit against the house. So this way, for accounting reasons, you have your mortgage, but you have your line of credit that you could, the interest is tax deductible, all these things you could do. They use that towards the down payment on the new property, and you put a mortgage on the new property. And again, you still have to qualify, but that's logistics in terms of how you would set it up.
That's what I want to make sure. So they have to qualify as a person. You can't look at that property and be like, listen, that property is cash flowing positive. Will the bank say, okay, you know what, that's fine as long as you don't?
And again, if it's the subject property, most banks will look at 80% of the rental income.
Okay.
Right, so we do look at that income that it drives. And again, if it's a new rental property, majority of the time we don't have leases, we don't have. So we will do, when the appraiser goes out, we do market rents. Right, and say, okay, this property could rent for. And a lot of times they'll give us a range, $3,000 to $3,500, whatever that range, and we use that as additional income on top of whatever income you have to qualify for that new one.
Can we use numbers just for the sake of an example? So say said client, we're still on scenario one. They have a home and now they want to pull out equity and purchase a one-bedroom, $600,000 apartment, which could rent out for, let's just say, call it $2,500. Okay. What are the numbers that they would be needing to come up with? Like, give us an example, like a tangible numbers.
Okay, so round numbers, easy numbers. Say the purchase is $500,000, right? So 20% is $100,000, easy numbers. So they had to come up with $100,000, and then you mortgage the rest. So the mortgage on the property is going to be $400,000, and if you're pulling equity out of your home, you're looking at minimum $100,000 to pull out of the equity. Whether you refinance it, whether you do a line of credit, refinance, however you want to structure it. So, and again,
but how do you qualify that person? You were saying for the 80%. So like, what would that look like? What would they need to do in order to make that move?
Yeah, so a lot of times it's planning, right? And I've had clients that I've done many rental properties, and one of my clients, everyone has limitations now, but I had one client, he had up to 13 properties. Okay. He had a client that he went to his bank, like, oh, I want to buy a rental. He's like, well, maybe one. He goes back to my friend, the client. He's like, well, how do you have 13? He's like, well, go talk to Piero. And it's not just me. It's not just me. It's again, anyone who knows what they're doing.
Right.
There's some planning that goes into it, right? So if the idea is, hey, I want to buy a rental property, well, get your refinance, get your line of credit in place, get that done, do in steps. Because keep in mind, when you're buying a property, that stress test comes into play. When you're doing a line of credit on your property, that stress test comes into play. But when you're buying, just say you have the one property and you're buying the next one, well, the actual payment that you're paying is what we use. We'll do offsets and everything. So that stress test on the existing property is not there. It's only on the new property. So back to that first property, when you get that line of credit in place, line of credit now, you could be qualifying at closer to 10% because, line of credit rates are at, call it 8. So if it's 2% above that, you're qualifying at 10%, right? Get that line of credit, get that approved, do that first step. You have that in place now. Now you work on the scenario in terms of buying that property for $500,000, call it. So you have that $100,000 or your down payment, whatever that number is. Then you work next. Okay, now if I borrow off that line of credit, this is what the payments are going to look like. Worst case. And now the stress test is only on the new property, not on both.
Got it.
Right?
Got it. Yeah.
So if that's the idea, work with someone, make a plan, devise a plan, and execute them in stages.
How long is this plan? How far in advance are you planning? Can this be done in a month?
Yeah, in terms of getting the line of credit in place.
How far in advance should someone make this plan?
I mean, as
it's immediate.
Far in advance that you want, right? I mean, again, if the idea is, oh, next year I want to get buy a rental property. Well, if the idea is we don't have the cash, we need to borrow off our primary residence. Well, what's wrong with getting a line of credit in place now? And if you don't use it, you're not being charged on it. And it's sitting there ready for you to pull the trigger.
They have to still double check with you because let's say someone's got $1 million property, pulling out $200,000 extra, so that $200,000 goes under debt. If they are purchasing the next property, they still have to qualify. So they have to come to you and say, listen, you know what? I want to buy a $600,000 condo, and I'm going to pull out $120,000 off my house. Will I still be first qualified to buy the second one?
And that comes down to the person they're dealing with.
Yeah.
Right? So I say you execute in stages, but you also have to calculate. I mean, there's no sense in doing the line of credit if you know the next step's not going to work.
Well, that's exactly what I'm saying. So
Right.
they have to talk to you to tell them this
Well,
is going
absolutely.
to
You
happen.
got to talk to your mortgage provider. Say, hey, this is the plan. This is what I want to do.
Yeah.
You know, and a good, agent's going to, or a mortgage broker's going to say, okay, yeah. So we'll qualify you for the mortgage. It looks fine. We can get the numbers to work. Now, next step, you borrow off that line of credit, $200,000.
Yeah.
Right.
These are the payments. The property's X amount of dollars with your $200,000 down. The stress test payments will be this. We factor in what the estimated rent's going to be. Is it going to work for that next step?
Right. Just for this to come full circle, I want you to talk about, I just took over your whole show, but it's fine. It's the first time I'm on. Did you realize? Feels good to have me, right?
First time? Guess
It's my,
We had
it's
to
my
change the
first
whole
time.
set for you to be here. So
I know. Thank you. I want, for this to come full circle, this moment, I want you to touch on, because you and I talk about this all the time. Clients come to us and they're like, oh, is it even worth for me, the interest rate's so high, is it even worth it for me to pull out equity or to get, whatever it is, and then make that move? It doesn't make sense. So I want you to walk through why it is a good idea.
So here's what I do with all the clients. So I'll be like, okay, listen, you know what? Let's
and slow it
assume
down so people get this.
you are refinancing this property at 3 years at this rate right now.
Okay.
Right? So we calculate how much yearly they're paying extra on the interest only, right? So your payment is going up, you're paying X amount right now higher. You're getting this other property at this rate, this is your payment, and the rental income that comes in is this much.
Yeah.
So we offset that, we say, okay, for example, even if you're negative, for example, you're negative 5,000 per year, 10,000 per year.
Yeah. So they're out of pocket, they're contributing to the payments.
Let's just
whatever the
assume
case.
that
Yep.
situation that,
Yep.
if, not an ideal situation. But this property that you're buying is probably on discount by 100,000 in today's
Because
market.
it's undervalued.
We're talking
If
about
not,
assignments.
if not more,
Like,
yeah.
If not
we've
more,
done
yeah.
like right now several assignments. They're all hovering between 150 to 200,000 below today's market value, right? So you're already buying something 150 to 200,000 below market value. Let's say you're going to be out of pocket 10,000 a month. Sorry, 10,000 a year. Over the next 5 years, it's going to be 50,000.
If you go 5 years.
If you go 5 years. Over the
Okay.
10, what I tell them is like, right now for the next 3 years, we know exactly how much you're going to be negative. It's 30,000. It's already offset in not only like that portion that you got a good deal. Mention the
But
fact
that
that
also decreases every single year if you can increase your rental income.
of course, yeah,
Agreed.
100%.
Yeah,
Right?
good
But like
point.
we're just taking it as a
Yep.
pure simple math, and so I mean like it makes sense. But the other thing is sort of like stop you here. The whole point is a lot of people got to be comfortable with the fact, because a lot of people look at it and they're like, okay, you know what? Damn, like my monthly mortgage for my principal residence is going up higher, and here. I might be cash flow positive, but still but I'm taking into account all the interest in here, like that I'm paying on my original house, I'm gonna be still negative.
They're like, why are we going to do that?
Yeah, and what I look at is, I go over 3 years and I'm like, right now you're ahead 100,000, 150,000. Let's assume 5 years, 5% per year, this property appreciates. So let's call it at a good example we had right now around 700,000. The property is purchased about 180,000 below today's market value. So let's just do pure simple math. 15%, this 700,000 goes up. You're what, at 125,000 increase just in the equity. You've already saved about 180,000. You're already around 300,000 ahead.
Yeah.
Well, I mean, if it's 10,000 a year, so you say in 3 years,
30,000.
30,000, and you made 125?
No, you made like 300,000.
300,000. Okay, not a bad.
Well,
not a
that's
bad.
the whole thing.
But and again, you got to keep in mind everything that comes into play. So you're not just talking about real estate. You're not talking about the payments. You're also talking about tax implications.
I was
100%.
just going to lead there, yeah.
Okay, right?
100%. It's forced. Yeah.
It's for savings. Someone else is making the majority of your payment. You're into it for call 10,000 a year.
It's just like a neutral year.
You're putting down whatever that $600-700 a month as call it savings into this property that's gone up to 300,000.
And I want to break that down because a lot of people don't understand when we say saving. Because let's assume you're renting your property. Let's just assume it at $2,500. Your mortgage payment is at $3,000. You're negative $500. You got to put $500 out of your pocket. Let's just assume that. That $2,500 is paying for your interest on the mortgage, your property taxes, and your maintenance. Let's just insurance. What you're putting out of your pocket is technically you're putting it towards your principal.
Your
It's
own-
gonna
yeah.
come out at the time.
You're putting it from one pocket and you're putting it in the
it's
other.
going to come out when you sell it. It's going to get released.
That's how I
And
look at
again,
it.
and I always ask clients, like, okay, this is your long-term plan. This is your retirement. This is whatever. So again, don't get caught in the weeds when it comes to short-term things, right? Again, if you're, and again, it's personal. Like, again, in your finances, say, okay, I'm short $500. Is it doable for the short term, knowing that it's going to appreciate? You potentially make $300,000 in a few years.
Yeah.
I mean, I say yes, but that's people get
I think
comfortable
with any investment, like, I place money and I look at it, some days I'm like, oh my God, it's so low compared to like what I initially put in.
Yeah.
It's like, I'm out of pocket.
That's why
But
you
don't
got to
look at
start
it like
investing
that.
in crypto.
I don't invest in crypto?
That was a joke.
You think I invest in crypto? No shot. I'm so not a crypto girl.
Yeah.
So, okay, and then like if they're pulling money out of their existing investment property to buy another investment property, works the same.
Yeah, I mean, again, I would
That's
do.
scenario B.
Yeah, I would still say, okay, you got to plan that, but do it in steps.
Okay,
Is-
just to
is
make
key.
sure you're going to get qualified to buy whatever you're looking
got
to
it.
buy.
You got it.
Okay, so perfect. So I mean, like now we got a plan for buying investment properties if someone is looking to do
It's
that in
important,
this market.
right?
Yeah.
Because a lot of people are like, oh, there's a good deal, but where can I find the money?
Yeah.
Like,
Yeah.
I can get this from my, family. Where else can I find the rest?
You don't know unless you start.
Just make the appointment, get the
start
consultation,
looking at the
nothing
numbers
to
and
lose.
start planning it, right? So, yeah.
Maybe you'll do my little financial planning.
There you go.
Yeah.
Okay, anything else we got to add? Anything else you think we should discuss right now as we're like heading into the
What do you
last
wanna
quarter
leave
of
us
the
with?
year? Yeah, any important points that you think worth mentioning? Anyone looking to finance, refinance, mortgages, buying, selling?
I mean, there's a lot of, I must call it fear mongering, but a lot of people don't know, a lot of question marks around everything. I mean, get in front of a professional.
Yeah.
Someone that you can trust that, even ask around, say, who do you recommend, and say, this is the plan, this is, and it may not be today, it might be 6 months from now, right? And at least you get the knowledge. Knowledge
It
is
doesn't
key.
cost you anything.
It doesn't,
yeah.
I mean, again, with my first time home buyers, when I sit down with them, I go, listen, you don't know what you don't know. That's my job.
There's another one-liner.
Oh, you like it? It's as much as a teaching session and learning session than anything else.
Right.
Right. So planning is key. And I always say this. I go, if you had $300,000, $500,000, $1 million to invest, you have a plan. If you're going to borrow, what's the plan? Right.
Exactly.
So.
And that's
Love that.
with everything, even like as you mentioned, first-time home buyers. We always tell them because it's their first time actually going to buy something, and they're, in my opinion, they're the type that are scared the most. So
for
it's
sure.
best to plan in advance, be in the market for, let's say, a few weeks, month, see what's going on before you jump. Because I see people are like, oh, you know what, I'm going to do this next March. Like, what's going to happen next March? You know what, like, be in the market, see what the deals are.
Be in a
Get in
ready
the habit of
position.
looking at properties just to see what's happening. So when you see a good deal, you can distinguish what a good deal is and,
And where you're actually standing, yeah.
Yeah.
Yeah. You just don't know, right? So.
Perfect. Well, Piero, thanks for having.
Thanks, guys. Thanks for having me.
Thanks for
Yeah,
having us.
for having us. Yeah, seriously, thanks for coming here. So guys, thanks for watching, and whoever enjoyed this episode, make sure to click that like and subscribe button and share it with whoever you think gonna find it useful. And also be sure to find out about our last episode about how to purchase pre-construction with Jeff Slidom.
Yes.
And if there are any questions in regards to pre-construction, we got Devany here that is gonna answer all your questions. Thanks for watching. We'll see you next time.